Now, some of you may already have an idea about what I'm going to be talking about tonight, and is in fact support and resistance. Uh, I have been in the past been sort of running them as completely structured sort of lessons for this Thursday, but I am going to try something a little bit different tonight, in which I'm going to sort of talk about stuff and give you a couple of examples in uh, on the sort of slides that I've got prepared for you for the sort of first half, and then the second half we're going to have a look at some charts, and I just want to sort of give you guys a bit of an eye for how we might line things up on the charts. So, as always, if this is your first webinar that you're attending, my name is Alistair Schultz, and I am the Chief Market Analyst for ACY Securities. And I have approximately 15 years of experience from working on the floors of New York to investment funds and a variety of other areas as well. So to get started, the first thing you have to sort of consider is that there is a risk disclosure. The trading can be risky. You need to consider all your investment objectives, your risk tolerances, your trading experience, to make sure that you understand all the implications and the risks that are involved, and to not obviously invest money that you can't sort of afford to have issues with. So the first thing to sort of get started on all of this is naturally going to be what support and resistance is. And I appreciate that it might seem a little bit basic to get started off with, but I promise you it will get a little bit more interesting when we get to the next section. So support and resistance represents really price levels where further price movement in a certain particular direction is rejected. With support, price tends to not fall below a fixed level, while in resistance, it tends to not rise above a fixed level. These price levels can occur when the balance between supply and demand becomes equal, and then it tips itself into the opposite direction, reversing a price movement. So your supply and demand principles are really reflective of support and resistance as well. Sometimes these levels can be determined by bigger players in the market. So you might be talking about investment banks and a variety of other places. And they might be trying to defend a particular price. An example of this would be the Swiss National Bank. And they had a policy to try and prevent the Euro chef from falling below 1.2. Over a period of several years, if price moved towards that 1.2 mark, the Swiss National Bank would actually buy euros and sell Swiss franc, which would cause the price of the euro chef to move away from a support level. So in some respects, you can look at that as almost a currency manipulation. They're pumping large amounts of money to try and control the fluctuation of price. In some of the charts that I've sort of looked at in the past, you can have a look at it. If you're interested in looking specifically at the euro chef, you'll be able to see it in much more detail. But considering the support and resistance normally occurs because of a changing supply and demand levels, you tend to find that it's really more focused on the traders that are actually interacting with the market, more so than the idea of the Swiss National Bank. So the next thing to sort of start thinking about and discussing is the static support and resistance. And what do we mean by that? So in the chart that I've got here for you now, I'm giving you sort of an idea of it to sort of have a look and have a think about it while I'm talking through this in the sort of next section. Static support and resistance really refers to areas of fixed support or resistance that are represented on the chart by horizontal lines or zones, like we're seeing right here now. Identifying areas of static support and resistance involves looking for a price at which a place has approached but failed to really exceed it. These sort of levels are identified at either swing lows, if it's for a support level, and a swing high if it's for a resistance level. Swing lows and highs occur when price is moving in one direction, but then refuses to move any further. So that's where you would get a price refusal or a price rejection. In this chart that I've got here, I'm identifying that resistance is identified at the point where the rising price is rejected and the price starts moving down again, or vice versa, it starts doing the opposite when it comes to the other place. Below that, price will also find a lower level where further falls in price are rejected and price starts moving up again. So you can see that where the first place I've got price rejection, it touches a point, it moves down, and then on the bottom side, it touches it and it gives you your first 2 points. So I'm not sure if you guys can actually see, well, no, that's not the one I want to do. So the first price rejected one that you can see, we've got the big green candle is the first place area I'm talking about. and the second is the first touch of that pink line. Now, later, the market sort of approaches those same lines again, and it fails to meet or go past that sort of support point. So perhaps the real value of studying support and resistance is that it has a predictive value in identifying a possible turning point in the future. So in the instance of this chart that we're looking at here now that I've got up for you, you'll be able to see that we're looking at where we might see price bounce again in the future. Now, it really requires that we have two places of defining price actually touching on a point, and that's really the only point that we can turn around and say, okay, we're now going to define that we have a push to a line. So a single touch can be enough to identify a potential level, but it's really not enough to confirm it until you sort of get price revisiting that level again and to be rejected. It's easier to see support and resistance levels in hindsight than what it is looking ahead. So, you always must sort of maintain an awareness of the previous areas where price has been rejected before, and you need to sort of observe or how it behaves when price approaches that level again. You can get other clues that the level is going to be rejected. It may be present and allow us to sort of take advantage of that sort of section. Some of those sort of areas that you might consider as being clues would be simple candlestick analysis and looking at what price is actually doing at that point. It's much harder to sort of allocate and put the idea of fundamental analysis towards technical analysis because it just doesn't always work together well. It does in some instances, but it's not as common as you sort of expect. So you do tend to find that support and resistance does play a lot more on psychological functions of trading and a variety of other little instances that you might consider along the way. If the level is retouched sort of multiple times, that line then does become a little bit more significant. For example, the next time the market approaches the line, there will be a higher likelihood that that area of support or resistance will hold. At some point in time, the support or resistance level will break. So returning to an area of support or resistance is not really guaranteed that resistance is actually going to occur. Other clues can sort of help how you can sort of have a look and feel how price might behave in a certain region. Clues, like I said before, will usually include candle patterns, sometimes indicators, smaller time frames sort of stuff as well will help a fair bit. And a resistance level that's sort of been visited more than a couple of occasions will quantify that you are likely going to see a better result down the track. A useful sort of trading approach might require to have more consideration of the other observations, so those little clues, rather than sort of basing it all off your support and resistance level. Naturally, something that you should sort of always focus on when it comes to support and resistance is that it can be, in fact, broken, for one thing, but they can also operate as a being interchangeable. So on one side, you can have support become resistance, and then on the other, if it was before resistance, it could become support. So once price sort of breaks through, you might find that the behavior of that line might change. A broken support or resistance line shouldn't be discarded purely because of that value. It could be significant at some point in the future. But you also want to be careful of muddying up your chart and having too many lines on it, which can get very, very confusing. So what we tend to find is, at least I found over the years, some traders actually refer to all support and resistance lines, support or resistance lines, as simply just SR lines, since each zone can be both a support and a resistance depending on where price is at the given time. Being able to sort of have a good roadmap for your market movement is obviously an appeal, and that's where you get support and resistance lines helping us out in that way. We've already sort of had a talk about, why support and resistance levels can provide information about areas where price is likely to be rejected from in the future. But an extension of this concept really is about creating previous potential support and resistance zones with the use of SR lines. You can then create a grid and sort of have an expectation that once an SR line is broken, the next one is now going to be in play. But we'll have a little bit more discussion about that a little bit later. So the next thing that sort of I want you to sort of have a think about is in this chart here, instead of it being just a static line, support and resistance really works with an idea of being in a zone. So not every single line you draw on the chart is going to fit perfectly. In this instance here, you can see that the lines kind of fit, but not exactly. And there's really a box around it that defines where we might be considering looking at price. It's also what we call a trend channel. So this is applying two concepts in one chart here. The idea of a trend channel is that you have run a parallel line. So if you were in a downtrend, you would always run your first support line from the top down. If you're in an uptrend, you would be drawing it from the bottom across all your lows. And then you would then simply copy, like hit the Control C button basically, and draw that line across the top of price. In doing so, it gives us a framework to sort of work with. We can trade our way through price. In this instance, consolidation. We can be taking buys off the bottom and sells off the top if that's what we so desire. And bearing in mind that we might give ourselves a little bit of breathing room as a rejection zone. So here we've got, the larger candles or the larger moves counted into that rejection zone. And you would be quite comfortable taking a trade for a short side anywhere in between that gray or purpley colored box for your position down or up, depending which side you are on, and sitting your stop loss not far behind it. So it is a way to sort of help us get through areas that we wouldn't normally consider taking a trade. The process to sort of thinking about this is in a little bit more light so you can see it a little bit better. I've got this diagram here that I've sort of done. And it indicates that, whilst there is a line in the middle, price can bounce around anywhere between that yellow box and you can classify it as that same rejection zone. The next piece we're sort of looking at here is how we see the change in price from becoming a normal set of resistance lines and then for it to be changing its classification from becoming support to resistance. And there are a variety of different ways that you can sort of think about this. The first way is to sort of deal with the trend line or the trend channel. So construct the trend line, identify the direction of the trend you're sort of drawing. When price is rising, naturally trend lines are drawn from the swing lows. And when price is falling, the trend lines are drawn from the swing highs. When we start applying that sort of ideology and then doing the copy and transfer to make a trend channel, it gives us that really good range to work with. But if it breaks out of that, it gives us another area to sort of look for an opportunity to go with the trend again. So creating a channel does become important. Now, there are a variety of different ways to sort of think about applying different types of trends and looking and using your support and resistance. Naturally, most of what we've talked about so far, before we are going to move to the charts shortly, by the way, most of what we've talked about so far has been revolved around the trend lines and channels, or even channels within channels. So I'm hoping I can actually go through live on the charts and find you a couple of areas where I might consider a channel within a channel. This generally comes from the use of much longer time frames and being zoomed into a smaller one. But regardless of that, you can then also have trends within channels. And this is another nice way to sort of look for trading opportunities if you haven't before. You can also get stuff where you have your calculated things. So that's really looking at Fibonacci retracements, pivot points, and a variety of other things. You can also use oscillators. You can use your oscillators or your indicating oscillator, the indicators known as oscillators, to draw your lines across those and try and find areas where you might consider it. You might be looking for divergence in price versus the oscillator, and certainly having a little bit of a support and resistance idea might be a bit handy in that instance. The other big one that you tend to find a lot of is actually 00 and 000 digits. There is a psychology that's involved with that where everyone sort of takes note of there being 00, 000 numbers in price. And so at those points, you do tend to find that there is always a little bit of support and resistance in that area. And I think that's got largely to do with the training that most people have. You'll tend to find that, even myself, I will talk about 00s and 000s being an impactful place in price. You will certainly see them actually happening whilst you're actually trading. And I think that there is a lot of education around that aspect. So if you were teaching more people about those sort of numbers, then the psychology of the market starts to change because they start paying attention to those sort of areas. So enough about sort of talking about this stuff and giving you guys a bit of a slide. I am going to just move us off to the charts themselves. So Here we have a euro dollar chart, and I'm going to try and put together a couple of different charts here and go through a couple of different techniques on what we might include with support and resistance. So the first one of these is going to be a trend line to start off with. We're going to give it a go somewhere around here. We might start up on a monthly basis. Whoops, that's not what I wanted to do. I don't think I have enough data right now, or it's not working. Sorry, guys. Go to a weekly maybe. No, let's leave it at that. So we'll stick with the 4 hourly because it's got some nice springs and movements going on in it right now. The first thing that we can do is we can obviously, this doesn't really encapsulate the trend all that well, although we do get a sort of an area here. Now, if I was considering the idea of running this like a channel doesn't necessarily have to be perfectly correlated. We don't have to have it being like this all the time and being a perfect sort of parallel setup. We can, however, use it to sort of put in a sort of area, and we might consider this area in between to be what we would consider that resistance zone. So anytime we see price, we're in a downtrend, that's been going for some time. The only other side risk to this is that we also have lower swing lows. Oh, I don't know why my chart is flicking back and forth like that. I'm sorry. It's making it very difficult to actually draw things. Please stop. Okay. Nope. So if we do decide to, think about that sort of aspect, then we do have lower swing, higher swing lows occurring at the same time as a downtrend occurring as well. So this sort of indicates to me that we have sort of a bit of confusion in what's happening, and it's been going on for quite a while. They're saying that price shouldn't be getting this low, but it also shouldn't be going anywhere near as high. So we sort of can use this area to really consider what we might do with our trades. The first of which would be, if the line stays on the chart, we can consider this sort of area here to be that rejection zone. So every time price gets into this sort of an area, we can start looking to take a position for a short. Now that we've seen price cross here in this area, then we know that the chances of resistance of it falling further might be a little bit higher than what it was before. To then move this down a chart, let's say we're going to go down to an hourly just to see if it has a nice look. And in here, you could then continue to do that same idea, but now you've got a channel to work in as well. Not before, this was just a rejection zone. Now it's actually something we can trade with. So if we do the same sort of principle, we have the bottom side and the top side up over here. Every time price touches the bottom, we're going to ideally try and see if we can get a long position somewhere down the track. And you would not always get every single one of these positions, but that's the idea of mitigating your risk as much as possible. Eventually, you would get one on this side and it would go up, and then vice versa, you could turn around and take the short side on it too. Right now, you could consider doing it. Now, if I was in the position that I'm in now, I would probably not actually consider taking a short position, purely because price has broken outside of our box, and I'd be waiting for it to come back inside this range where I have more confidence of there being a level of support below me to take a long position on it. But again, counter trend trade, so you're going to want to be thinking about having a smaller risk profile for a long position if you are in a downtrend. Moving this even closer down and narrowing it right down, the next place of interest that you can start doing is to then start using your trends or your support lines as a way of exiting your positions. So the first way that we can start doing this is simply by drawing a trend line like so, and then we can keep on moving them down as we see sort of fit. So here's another one here that we can sort of put quite easily and quickly. There's another one sort of across this way that we could possibly use. And this very point in time, we've got another one that's sort of gone down this way. So the idea of these are that in reality, just sort of playing it out so you can see what it would look like from a back testing point of view. And then we'll try and do some live ones if we can see them on the charts. But the idea would be that in here, you've got this line. You can't classify this as a trend line until you get to this point here. So once you get a definement of it around here, you'd be looking for a long entry at this point, be aiming to go up. On the break of this line just here, you'd be looking to close your position. So you'd be up a few pip, not a huge amount, but enough to call it quite happy. Then we'd be looking at the downside again. Now, with this point here, we can't draw a trend line until we really get to about here. I still wouldn't be comfortable with it because it's such a fast fall, but you could still definitely use it. And so if you were to get into a position somewhere after you saw a definement of it being a trend, perhaps somewhere down at this point here, you would then be able to follow it all the way down. Once price breaks this trend line that you've drawn, you close your position for a profit. Again, now we're waiting for the next sort of lines to be defined, and it doesn't get defined until here. Price moves along, goes up, goes down, and you would have tried to have been getting in for a long position somewhere at this point, roughly. Now, if that was to occur, then it would have gone up. You may have, if you had a set of take profit, been able to get it, but chances are you wouldn't have seen this move happening here, and you would be closing your position possibly for a loss, if not break even at this point here on the break of your trend line. Again, you draw another trend line going down. So at this point here, you would have been able to define it, which is basically where we're at now. And we start to look for an opportunity to take a short position. If we move it down even further, we can zoom it into the 5 minute and have a look. And now this is the beauty of using support and resistance. It's not you don't have to use it on a particular timeline or time zone to sort of work with it. You can have it in any time frame that you like and work with the pattern in there. In this instance here, you could continue to do that, and you could move your trend line down to even further. The next chart we can move on to, and we were going to talk about, see if we can find somewhere that has a bit of an idea around one of those trend channels that might be sideways. Now, I'm not sure if we really are going to get what we want tonight for that, because we have had some very turbulent price action between here and here, but certainly we can probably use it in other places. So let's stick it at the monthly chart if I've got enough. Yes, I think I do have enough to get a line on there. Yeah, that'll do. So we have our first one. Seems to be continuously loading data. That's a new one for me. I've only just downloaded this platform for us to use, and I don't think I've flicked it to the right time zone before this moment. So that could be causing some of this jittery issue that's going on right now. Okay, that's near enough, good enough, I think. Can't quite get it in the right spot. There we go. So the next thing to sort of consider is we move it down to the 1 time frame again. Now this provides us with a number of trading opportunities that we can use. We can also start incorporating some other things as well. If we go into our indicators list and we look for Fibonacci retracements, we will generally find a few interesting things that you can use to sort of take a guess on where we might see some variable sort of changes in price itself, but also about where the support and resistance might end up being. Now, like I said, this is new. I'm just going to do this on my other one. Might be a bit easier for me. There we go. Let's find a chart that we don't usually look at. Okay, so now if we're considering the use of a Fibonacci retracement, there are 2 sort of rules to come. Now, they are all about support and resistance. We do still have the idea of a rejection zone going on, and it tends to look like this if you've ever seen one before. This line where we leave the retracement level is what we call 0%. The next one's 23.6, 38.2, 50, and then 61.8. We tend to find that between 50 and 61.8 is where you get your most reliable changes in direction for price. And it is usually where you get a fair amount of resistance. But nonetheless, you can see that it actually has impacts on a variety of different things. So here, the 38.2 has provided ample amounts of resistance for us to start considering what might happen next. Again, we're seeing price get held up right here now on the 50% line. So it will bounce around, and you have to sort of consider it to be a little bit like a rubber band. Price will try and find and test its place out as it progresses through something, and it will expand and then contract before it takes off again. So here, there are a number of elements that are sort of going on, and you can move the idea of the Fibonacci retracement right down further again if you wanted to. Instead of it being on the whole overarching thing, we can then move it down to a much smaller level. And you can see it at most of the points here. We do have a point where price has sort of tested, left a nice wick for us, but then it has taken off somewhere else and it has basically gotten stagnated on price just for a hot minute. Now, even though might be only one of the other ways to do things, what I am really trying to find for you tonight to sort of give you an example of is how you can look within a trend line, a trend channel, and then find some alternative ways to sort of trade through price. So here looks like we might have a half decent one that I can just use as an example. In doing it in live time might be a little bit hard tonight. So the first thing to do is draw a trend line up like so. We can see that we do have price respecting it quite well. There's more than a few touches. We have 1, 2, 3, 4, 5, count it up as you go. And then we can sort of start transferring this across. So the first thing to do is you put one approximately here, because that's the tightest range that we have. Then we will put another one at this point here, because that is really the next one at about there. And then the final one is at this point here. And it doesn't give us a bad range to work with. We have a middle range here where we might consider looking for positions, but generally as a rule of thumb, if we're in the middle of a channel, it's very hard to sort of take a real guess because you don't have perfect support and resistance parameters at play in the middle of a range. However, if you do have them at the opposite end of each side of this, so perhaps on this side or this side, then it will provide some good places for you to sort of have a look for some entries. Now, I tend to like looking for them, sticking with the trends. So in this instance, I would probably dominate my entries with being long positions. I would look every time from the bottom side, I'd take my longs. I wouldn't really consider taking short positions because it is the riskier play. Another way that you can consider using your trend lines and trend channels to try and find some support resistance, which I know a lot of people haven't really heard of this. So I know that when I do it, most people are actually quite interested to see what I mean. Now, the first thing to do is to mark out your charts with the week that happened prior. So today being Thursday, we then have Wednesday, Tuesday, Monday. So at this point here, that's my first blue line. The next one that I look for is 5 days prior to that to the previous Monday. So Friday, Thursday, Wednesday, Tuesday, Monday, and we have our next line here. We then draw a line between the close and the close. So that is this point here. We then draw a line from the, copy this line across to our swing high and our swing low. So the lowest point on this chart is about there, and the highest is at that point there. And we start looking for that as a potential range to work in for the following week by raying them out. Naturally, this doesn't work every single week because you do get events like we are seeing right now where it's just not actually useful at all. But if you were to have used it in this area, then the chances are you would likely find that it has been useful. So to give you another example of it, and just to show you that it does have some level of effect, we go to there, we draw from our close to our next close just here, and then we can then drag this down to find where we might expect price to move into. Like I said, every week doesn't always work, but it does give you a bit of an idea. It can also help you sort of identify when you might find a change in trend. In this instance here, we're looking at what we might consider a change in direction of price, and we can start scaling it out. So if I then draw it between now and say today, which isn't going to be as useful purely because we haven't got a full week, it does sort of indicate, you can see it starting to curve over. We've gone to the high, the low, the open, the close of that sort of range that we have in current price. And we can see it sort of starting to curve out. If we sort of look at other places in price, it might be on something else. We'll have a look at Euro Yen now and do the same sort of thing. Then you will find it happening a little bit more often. Another one to sort of do it with could be potentially here. So we've got Thursday, Wednesday, Tuesday, Monday, first one. Then we go another 5 from there to make our week. And there we go. And then now we sort of go, all right, well, the start is, this is the close price. This is the close price. Bring it to the high. bring it to the low. And then there we keep on going with them all the way through. They are not always effective, but if you have no idea where price might be going, they can be quite useful. Now, if you are going to start using them with oscillators as well, there is another option for you to do it there. So when we think about you looking at our oscillating sort of things, we're talking about MACDs and, oh, oops, got to go in here. We got to sort of think about our MACDs and momentums and other things along those sort of lines. Now, in here, the idea is that we're looking for divergence. So the meaning is that if we have price, say, going down, then we want to be looking for the oscillator to be going up and be able to link those sort of trends in place. The same thing can be said, and for almost always, usually the oscillator is the one that is going to be correct. That's generally what a technical analyst would say. But you need to bear in mind what is going on in the charts to beyond the charts and sort of think about it from a fundamental basis. Now, here we can see it's below zero, below zero, below zero. And if you might have been trading in this area, so let's say that we are trading in this range, got it on Ray. Let's say that I sort of consider the option that we've been trading in the last week along here. Then one of the ways that we can sort of consider looking for our positions is once we have two peaks that we can draw them on, we can go along like so. And now we have a place of reasonable guesstimate on where we might get in. We can see that when we've had both peaks occur, that we've been able to match it up on here, which indicates that we are likely to see a price move in that general direction from about this point onwards. So we could start looking for an entry around here and then hold that position until we see the oscillator break price. So support and resistance don't necessarily have to always be used around getting an entry. It can also be used for a stop. Now, if you are considering that sort of side of things, then it's much easier to sort of recognize where support and resistance is, because you've got a different set of rules for getting in and a completely different set for getting out. I tend to prefer to use them in that method if I am going to use them, but on the whole, I don't tend to rely on sort of trend channels all that much, purely because they are really just a line at the end of the day, and you should really start to consider fundamentals in conjunction with this and any other method that you might decide to use. Now, if anyone has any questions about what I've sort of covered so far tonight, please feel free to start putting some questions in the chat box, and I will do my best to sort of answer them on the fly while we're here. And of course, there's always a segment to sort of go through on what I'm sort of thinking at any sort of time about anything. You are welcome to send me an email. I have a frog in my throat. For next sort of things to sort of consider for you guys, if you have enjoyed tonight's webinar, I do run them on Tuesdays and on Thursdays. Tuesday night is always about looking at the charts on the whole, and I will happy to give you my perspective on any chart that you like. So on Tuesdays, bring down anything you might be considering. You might be thinking about a trade. You might have a pair that you need some more knowledge on. And I'll mark them up live from a technical perspective. And I will also, if I know the market, we'll talk about them from a fundamental point of view. If you have more interest in some of the stuff that I do, and you've liked these webinars, then I would suggest that you have a look at some of the videos that I do. And of course, the blogs that I write as well. They might give you a bit of an idea. The website for which is down here on this part of the slide, just there. The other side to look at as well and to consider is that we have a number of other webinars that do go on. I am probably considering the idea of redoing the one for today and a couple of others just to improve upon them. And it has been a little bit of a test tonight, so thank you all for being my guinea pigs. But I will certainly be constantly improving these and providing as many different insights as I can for the Thursday night based stuff, which is much more educational. Now, if you do have any questions that you don't know right now, you might not have thought about it, but you want to get in touch with me, feel free to shoot me an email at talktoal@acy.com, and I'll quite happily get back to you. Now, if there's anyone's got any questions related to tonight's webinar, I will quite happily answer them. I'll give you a couple of minutes to sort of think about it. But if you are sort of finished up, then feel free to check me out next time, and I look forward to seeing you next week.